Hi everyone, my name is Bobby. Hi Bobby. Hi, some of you know me, some of you must have seen me at the meetup page, most probably. I'm here to do a short introduction and then we'll start with the talks. First, this is mostly organized by the AI Lab and the Blockchain Lab here at PhD. You'll hear about them. The AI Lab is something we started a couple of months ago, and we have various events. This is one of them. We also every Monday have co-working sessions where everyone who's interested in machine learning, artificial intelligence, deep learning, etc. can just join and work on their projects. We have physical space for that. Every Monday at 2 o'clock we start. You can just come, be surrounded by like-minded people working on their own projects. You can follow us on Twitter. It's the same concept with Blockbar or the Blockchain Lab. It's, however, on Friday. During the day on Friday, we have co-working sessions and also various events, presentations, workshops. These two communities are mostly organized by the same people, and we are based in the Hague Tech. This is the building that we are all now. It's a startup community, technical startup community that started quite recently, only last year. The first startups moved in the summer, so we are quite new but already quite growing. More than half of the technical events nowadays in The Hague are hosted here. So if you're not familiar, check it out. This is the website. We still have some office space available, so if you're looking for office space, it's really good, but most importantly, not so much about the office space as the community. It's a community of technical entrepreneurs, startups, and scale-ups. There are people working on blockchain, people working on artificial intelligence, on software, all kinds of projects. It's really cool. Check it out. And this event is, as I said, one of a few different events that we are planning. For example, this month only, we have 3 more. Next week, we have artificial intelligence in space. If you're in our meetup group, you must have seen it. It's co-organized with another sister community, Space Explorers NL. So if you are into the space industry and you want to hear a bit more about the artificial intelligence and its applications in space, join us. Then on 23rd of May, we have a computer vision workshop here, again, with a case study on driverless cars. So if you're into that, again, join us. On 24th and 25th, we have a small conference that we are going to host here on blockchain. What was the name again, Bart?
Blockchain Innovation Week.
Yes, Blockchain Innovation Week. It's brand new. We just announced it like yesterday. So 23rd and 24th of May. 24th and 25th, sorry. Yeah. It's Thursday and Friday. We have various presentations, speakers, even speakers from abroad, so it's going to be very, very interesting. Join us. More information for that on the website of the Hague Tech or on meetup. After the first talk, there will be a break. You'll see the agenda in a bit. And we'll have pizza, and the pizza is sponsored by Cloudflare. So this is the agenda for today. We're a bit late, but yeah, Sander will start in a minute. Then we have break, and we'll have our pizza. Sander will talk about high-frequency trading, and Eric and Mark will be more on the technical parts of how to build a trading bot, how to use it, how to optimize it, etc. We expect to finish about 8:30, but stick around, we have more beer, so feel free to drink as much as you want. We are not in a rush for anywhere. So that's it for me. Sander?
So great to have a big crowd here today. Very happy to see a lot of interested people in our subject for today. I don't really have as much of a technical session as the other session, so maybe you'll learn a bit more from them. My session is more about what do we do with BlockTraders, and I also want to give you all a small introduction into high frequency trading. I specifically say high frequency trading and not algorithmic trading. In my view, those are two separate subjects. Well, you will know a bit more about it after the talk. So, BlockTraders, as mainly all the companies here at Hague Tech, is a very young company. It was started in December last year by myself, and my colleague Maurits, who sits there, has joined me in March. So now it's the two of us, and next week we'll have an intern as well. So it's three guys in a small office there in the hallway. So my personal experience, I've worked at ABN AMRO for a few years. That's where I learned about trading and all those type of things. Did a bit of financial education as well. And I worked at various startup companies. My last job was as CEO of Leapfrog 3D printers, a small 3D printer manufacturer here in the Netherlands. So I like running young startup companies. I like finance and trading, and combined that set me up, I think, pretty well to start in the crypto trading space. Well, my studies match pretty well, so technical background. And I really like the game of trading. I'll tell a bit more about that in a second. Well, Maurits has a very complementary profile, I think, even more versed in the technical side of things. So he really makes sure we have all the infrastructure we need for scaling up our trading operations. I really like the game of trading, and when I go to work every morning, I'm pretty excited still. I've been doing this now for about 7-8 months, and the reason I like it is that I think crypto trading is sort of a big game. It's like you're playing Counter-Strike, but then it's whoever is smartest can win. You all play against each other. Everybody's programming. Everybody's trying to trade. And well, the people with the best trading algorithms get the highest score, and the score, happens to be money in this game. So from that point of view, I think it's very interesting, and I really like it. And well, given the large amount of people here, I think I'm not the only one. So I think it's a very interesting subject, and happy to be able to tell a bit more about it. BlockTraders is an AI-powered, high-frequency algorithmic cryptocurrency trading company. It's one sentence, and I will explain it starting from the end. So we're a trading company, so that's really what we do. So we make our money by trading cryptocurrency. So we buy, we sell, we do it all via our algorithms, and that's the only way we make our money. We don't really have any customers. We just have our own money. Customers. We just have our own money. It's sitting in our various exchanges accounts. We buy, we sell, and if we do it smart, at the end of the month, we have a little bit more than the beginning of the month, and it pays for the rent. Cryptocurrencies. We trade cryptocurrencies. Why am I super excited to trade cryptocurrencies? I've worked in the financial world, and in the financial world, in the traditional finance world, it's very hard to start your own firm. It's not a fair game. It's not a level playing field. If you're a big bank, you have lower costs because you have good contracts with all the various exchanges. If you're a high-frequency trading firm, like in the Netherlands, we actually have one of the biggest players in the world, BlockTraders and Optiver, and they have the best computers. Their computers are actually in the building of the exchange, right next to it. And they have the shortest cables, because having a shorter cable actually reduces the time the light travels or the electricity travels. You can't compete with those guys. If you want to start for yourself, you're losing from day one. Cryptocurrency, it's a fair game. Everybody trades on the same exchanges, on the same APIs, the same fees. So if someone else does better than we do, they're smarter than we are. That's basically the game. So that's why I really like trading cryptocurrencies. It's algorithmic. Algorithmic, means done by our algorithms, calculated by our computers. I don't know as much about cryptocurrencies as probably anyone in this room. I'm not an expert. The reason is I find it interesting, on a personal level, but from a business point of view, we let the computer do the reasoning about whether we should buy EOS or something else. Because we just look at the prices, we look at the development of the prices, and we'll get into the details of that. But it's we're quite agnostic. It's for us. It's like trading stocks. It's like trading anything else. The computer does the thinking, and it does. It's high frequency. I'll get into a bit more detail later on that. But what I mean by that is we trade fast, and fast is about once a second in the crypto world. If you trade high frequency in the traditional finance world, it's even a million times faster. But we don't buy something and then think, oh, maybe next day or next week it will go up. It's really short term, and we'll get into that a bit more. And it's AI powered. And in the end, we have our strategy in our office. We give it a lot of thought. And why have we started this company? For us, it's about learning about AI. I think artificial intelligence is the future. The AI lab that we have here at the Hague Tech, it's really cool to be close to it, and I think that artificial intelligence will unlock a lot of new industries. I love to work with it, and for us, trading and using AI as much as possible by doing so is a great way to learn how to use it and to hone our skills in the AI world. So we're AI powered, and the end of the presentation goes into how we apply AI to our trading operations. So enough about the company. I'll tell you a bit about what I understand as high frequency trading. There's no clear definition, so I'll just tell everybody what I think is high frequency and regular, let's say, automatic trading. An introduction to market making, a specific form of high frequency trading, and how we use AI to accomplish this. So I guess this is sort of the screen that everybody thinks about. I'm just assuming the audience here knows a little bit about trading, knows about computers, automated trading, maybe seen a movie or read Flash Boys by Michael Lewis, which goes on the subject. But this is what people think. Big trading rooms, a lot of screens, a lot of computers. This is not it, because if there's a human involved, it's not high frequency. Humans are too slow to do anything that is fast, right? So it's maybe more about this. And these are just two pictures I took from the internet, so I won't take credit for anything, but it's analyzing a lot of data and doing smart stuff quickly based on the data. And what I have here is yesterday's Bitcoin price. 24 hours. The letters are a bit small here, but it starts at midnight UTC until midnight UTC yesterday. And it's the Bitcoin price. And you can do a lot of interesting automated trading stuff based on this, based on which a lot of people trade. And maybe the next presentation will go into this, but you've got a lot of different strategies. You've got momentum strategies, for instance. Like if the price goes up, maybe it will continue going up, so I will buy. You've got mean reversion, which is basically the opposite of momentum, where you think, if it goes up, maybe it goes down a bit, and it goes around a certain price. You've got a breakout that says, you've got a few peaks here, maybe the head and shoulders pattern, and then when it goes above it, it might go up even more. A lot of interesting trading stuff that you can do with this data. But in my view, this is not high frequency trading. This is automated trading. You look at the ups and downs in the market. You think about what it might do. You might even program your computer to do it, but it's not necessarily high frequency data. In order to go into high frequency data, let's zoom in a little bit. So you've got the full day of data that people typically work with, but we're going to look at just this little part here. 5 minutes of data somewhere at the middle of the day. And this is really what our world looks like. It's much higher frequency, and the market microstructure becomes much more important. So this is really, I've heard a lot of talk on a lot of crypto meetings here about providing liquidity. If you have a new coin and you want people to be able to buy and sell it, there has to be liquidity in the market. And the way that you see liquidity is really on a small scale micro level. So this is 5 minutes of data. So I'm afraid the beamer cut off the time axis, but every vertical grid is a minute. what you see here is the ask and bid price and the actual trades that happen in the market. So the ask price is the best price for which people, they're actually, are they the right way around? Anyway, you've got the price for which you can currently buy your crypto or whatever it is, which is always the high price, and you've got the price for which you can sell it, which is the low price. So if you want to buy it, the market makers, the people that are actually offering their goods for sale, they want you to pay the ask price, which is a higher price. If you want to sell it, it's the lower price. So if you're a regular low-frequency trader, you can actually see the difference between ask and bid as a transaction cost, and that's called the spread. I'll go into that a bit more. The other thing you see on this chart are these bubbles. So those are the actual transactions. So anytime you see a yellow bubble, it's when someone has bought Bitcoin in this case, and when you see a purple bubble, it's when people have sold it in this case. So we spend a lot of time looking at these graphs and thinking about, well, what's happening here? For instance, you see here, for 1 minute, the price is totally stable, and nobody is buying and selling. In my view, that tells me that there's a lot of automated trading going on here, because when the price fluctuates, immediately there are orders. So I think there's a lot of computers involved, because people are not fast enough to see, oh, now the price is stable, I cannot make any money, I don't do anything. And here, there's a lot of going up and down, and there are a lot of trades. So I think already a very large portion of all the trading that goes on in crypto is automated. Yeah, and I just think it's very interesting to look at that and to think about how to make money on it.
By the way, are we talking about one particular exchange over here, or is it a combination of exchanges?
This is one particular exchange.
Okay.
Yes. It's a very good question, and I'll actually get into comparing various exchanges in a second. If there are any more questions, feel free to interrupt. I like interactive discussion. So I'll go into market making, which is to a large extent what we do over at BlockTraders. It's a very common high-frequency trading mechanism, and basically what it is, it's what in the 90s and before that, the people on the floor of the New York Stock Exchange used to do, and it's matching buyers and sellers. It's when someone wants to buy something, you sell it to them. If someone wants to sell something, you buy it from them. And in each transaction, you make a little bit of money, and hopefully, at the end of the day, you have more money than the money you started with. Of course, people are replaced with computers nowadays, but it's the same concept. So, as I said, you have the ask price and the bid price. So the spread is the distance between those two, and it's basically the money that we as a market maker might make. So whereas if you're a low frequency trader, you would typically pay the ask and you sell for the bid, so you lose that money, and that money is being paid to the market makers, or the people that actually provide liquidity. So how should you see this? A market order, if you write a simple trading bot, you will typically always execute market orders. It just means I want to buy a Bitcoin, and you do it immediately. You say buy, enter, and on your exchange, you see you don't have dollars, for instance, anymore, but you have Bitcoin. Immediate execution. The drawback is that you pay a worse price. So you can see it as, I want to buy this, I am a customer in a store. You go to the store, and at the moment that I choose, I buy it. At the opposite, you have limit orders. A limit order has uncertain execution. You don't know if your order will actually be executed, but you get a better price. So basically, you are the store. You are sitting behind your counter of your grocery store and just waiting for customers to come in. I think that's the best way to describe it. And the strategy that you can do with that is make money by quickly buying and selling the same stock with limit orders. So because as a market maker, you actually pay at the bid and you sell at the ask. So you buy it, you sell it, you buy it, you sell it, and you make a profit. So by buying and selling one time, you are back at your original currency that you had. The profit is the spread minus 2 times the transaction cost. So this distance between the buy and the sell price, and well, of course, minus any cost that the exchange might charge you. So it's a great strategy. It's easy. You buy, you sell, there's a margin in between, and you reuse the same money all the time. You don't need a lot of money, but it's difficult. Unfortunately, it's not that easy. So why is it good? Why do we like it? Why do we want to do market making much more than, for instance, speculation? It requires very little capital. If you have 100 euros and you're able to buy and sell 100 times in a day, then you've traded for 10,000 euros, and then you multiply that by whatever profit percentage you make, and even with a little bit of money, you can really churn through it, and you can be really active, even if you don't have millions to trade with. A strategy can be assessed relatively quickly, and what I mean with that is that if you have a strategy that maybe trades once a day, if you think it might go up, it might go down, and you have a bad day, your strategy can still be good, but it just takes maybe a month to see whether you make any money with your strategy. In market making, it goes so quickly that within a day, you can typically tell whether you have a good algorithm or a bad algorithm. And it allows you to iterate relatively fast. But nothing comes for free. There are big disadvantages as well. It's basically a zero-sum game, which means that there is a total pot of money in the world to be shared with all the market makers, because we're all dependent on people that want to buy and sell whatever crypto there is. And we're all competing for that same bag of money. As a result, the spread is often very close to the fee. So on many exchanges, you might pay 0.1% transaction fees. So the spread is typically around 0.2%. The difference between the bid and the ask price, which means that this round trip won't be profitable anymore. Large traders often get lower fees, which means that you have to be a large trader and able to be able to beat them, or you have to be much smarter. And the most important one is the information disadvantage, and it's a bit hard to explain, but for instance, let's say there's a news item, and this news item says the Dutch government has accepted Ethereum as their official cryptocurrency that will be used for everything. Then Ethereum will probably go up. That means that a lot of people will try to buy Ethereum with market orders, and that us as a market maker, we're selling that to them because that's our function. But then we won't have any Ethereum anymore to benefit from the rise. Likewise, if it goes down, we will be holding everything because people are selling it. So you always have a disadvantage as a market maker, and you have to overcome that. So let's say the strategy I showed here is the naive market making strategy. You probably won't make any money on that, but there are various strategies to improve the odds. One of them is pattern recognition. Computers, and especially neural networks, are typically good at that, to see, well, if the price goes up, it often continues to go up for a few minutes maybe, or maybe if one coin goes up, the other one always goes up as well. You can see a lot of connections there, and computers are good at recognizing those. You have cross-exchange arbitrage. Your question, indeed, is this the price on one exchange, because all exchanges have different prices? Or you have cross-currency arbitrage. So, for instance, if the price of a Bitcoin quoted in dollars goes up, the price in euros will probably go up as well. And if it hasn't, you might want to buy it quickly before it goes up a little bit as well. So, a lot of strategies to do that. And I'll give you a small example of how we do that. So, this is the price I showed earlier, a bid-ask on exchange A. And this is a different price on exchange B. And I just take the mid price to make the graph a bit easier. There's a constant difference here, and you see that often. For instance, this exchange might have fees if you want to take your money out, and then it's typically worth a little bit less than on the other exchange. So often there's a fixed distance between the two. So what we can do is we correct for it. I hope it's visible from the back, but I just subtracted the mean and basically laid this price over this price. And what you see here is that the yellow exchange is actually a bit faster than the other one. The yellow one goes down here. This one goes down 20 seconds later. So if you are already selling here because you know the other price will go down, you have an advantage. And it does it every time. Here, the yellow one goes down, the other one goes down later. Here it goes up, the other one goes up. So if you see this and you correct your algorithms for it, you can be a better market maker than your competition. And that's the only way to make money in market making game. And yeah, that's why I really like it. It's just trying to be smart, trying to use information and adjust your orders in a way that you can actually beat your competition.
But your algorithm will fail immediately if you're in the red zone there, right? The red goes down, but the yellow stays the same.
Yes, yeah. So exactly. So it's difficult. It's not that this particular strategy is perfect, indeed. So maybe it's just a coincidence that this graph shows this, and in the end, you don't have to be always right, but you just need to be right more often than you're wrong, I guess. But yeah, very good point. So what we do at BlockTraders is we use AI to implement those strategies: pattern recognition, cross-currency arbitrage, cross-exchange arbitrage, and anything else we can think of. So basically, we take 3 steps. Basically, all exchanges have an API. Most of them use with WebSockets. They just spit out a lot of information. And I think importantly, it's often information that you cannot get afterwards. So you might be able to download aggregate price and order book information exposed, but the order book information typically is only given at the moment itself. So you need to log everything. And we're not the only ones doing that. I know there are more people out there that have the same idea, but we track all the relevant exchanges and we download everything, because I don't know what might be interesting a few weeks from now or a few months from now. So we download everything. We have a stack based on Go.
Is that free data that you download?
Yes. Yes, it's all, as far as I know, all exchanges give their data for free. At some exchanges, you have to be authenticated, logged in to actually get the data. But even that is very rare, but it's all free. So it's free to download, but yeah, you have to be online all the time. If you miss it, it's gone. So, but it's free, yeah.
And talk about the largest exchanges.
Yes, well, so I have a preference for the larger exchanges because on those you can trade more. So even if you have a smaller profit
Liquidity is
margin,
much higher, yeah.
yes, but at the smaller exchanges, typically the spreads are higher.
Right.
So it's always a trade-off. But in my 6 months of experience in this game, it's easier. It's more effective to trade on the larger ones. Also because their APIs are better and everything is. But we also track some of the smaller ones because from a trading perspective, they are sometimes interesting as well. So we have a highly efficient software stack to automate this, to make it quick enough to capture about 10 gigabytes of data a day. There's a lot of stuff coming in. And the second step is to analyze it. So what we do is we try to predict basically the future based on all these inputs. So we've got order books, we've got transactions. It pays for the rent. So really our goal as a company is to keep growing this, store all these data, really become artificial intelligence experts by doing this. Work here with a lot of fun people and have some fun while doing it, and hopefully make enough money to pay the rent for the time to come and stay here at the Hague Tech. So that is a very short introduction on what we do about AI-based market making, and I hope it was of interest, and happy to take any questions if there are any.
First round of applause. When you started these 7 months ago,
you
didn't have anything, I guess, no algorithm, so you built something. And then for how long did you trade it before you started to see some results that were positive? Or can you tell a bit about?
Yeah, so to be honest, when I started, I was a bit lucky. I quit my job in August last year. And that was a very good timing to become a crypto trader, obviously. Not only because the prices were going up, but because the volumes were going up really quickly. So all these exchanges, nobody really knew what they were doing. So my life was really easy back then. So my first algorithms just to be honest, didn't include any AI. It was just, okay, I started with Kraken, which is a large exchange that does both dollar and euro trading. And basically I just looked, okay, a Bitcoin, how expensive is it in euros? How expensive is it in dollars? What is the euro-dollar exchange rate? One of them will always be cheaper than the other one. So I bought one, sold the other one, and did it the other way around. Perfectly simple strategy, and it worked until December. And then more and more people started coming in. And so my problem wasn't really that after December, January, the prices started going down. My problem is really that Goldman Sachs is now trading cryptocurrencies. My problem is that hedge funds are trading cryptocurrencies. So these simple arbitrage strategies are getting more and more difficult. And I'm pretty sure if I started today, when I started in August, I would fail. I wouldn't be able to make money to pay the rent and to continue learning. So, and from that point of view, I was lucky to start when I did. And now we are transitioning more and more into AI. So our business plan basically says we want to pay the rent with the traditional strategies. So we spend about a third of our time on the what we call the legacy algorithms to just keep them to pay the rent, but they're not the interesting thing. And you know, when that's settled, we spend the rest of our time on the AI algorithms. So yeah, and those are it varies. So for some very simple things, it's easy to just train an algorithm to, you know, recognize momentum strategy, whether it will go up, whether it will go down, and that's easy. But my sort of the holy grail is to just have all the data in one big network and really say something about every pair on every exchange, and we're a long way from that. So yeah, ups and downs.
Thanks.
Yeah.
What I always find fascinating in the crypto world is that you see all the different coins behave as if they are one asset.
Yeah.
If you know what I mean.
Yeah.
And I just cannot figure out, you know, how this happens. So how is it possible that all these coins, especially against the Bitcoin, they move as, you know, like almost like synchronously?
Yeah, I've seen the same.
Yeah.
My hypothesis is basically that a lot of people are, for instance, interested in cryptocurrencies in general. They read a bit about Bitcoin, maybe about Ether, AO, some of the big ones. But then you've got the altcoins as well. And that basically their idea is, okay, altcoins will go up today, and they just buy a little bit of all the altcoins. And if everybody does that, then other people see it going up, and they do the same. And it's sort of a mass hysteria. So basically, I think it's that people are too lazy to do research on all the altcoins, so they just sort of buy a bucket of everything and sell a bucket of everything without there really being a reason other than, well, today altcoins are going up or down. And for us, it provides a great opportunity because there's a lot of correlation between all of them. So if all the altcoins go down except for one, it might be that this one altcoin has something great, you know, their testnet went live and therefore they're going up, or maybe they're just a bit late and they will go down as well. And that's obviously something that our algorithm might take advantage of. So I don't really have the answer, but that's my hypothesis.
So you believe that all these users, they are the cause that those prices move almost the same.
Yeah, well, because I'm obviously quite convinced that the price is in the end a result of all the demand for buying and selling and the sum of that. So something along those lines.
Do you have any idea how much of the spectrum is, let's say, algorithmic versus essentially human?
I
traders?
do not. But if you look at this, this really gives me reason to believe that 70% is algorithmic, or maybe even more, because here, you know, there's no reason for a human to not buy here and to buy here because this is 1 minute. You know, you don't take that minute. Oh, now I quickly buy. But the fact that when the price is stable, there's nothing interesting, and when the price goes up and down, there's a lot of trading.
Yeah.
This tells me that there is a lot of algorithmic trading going on. So I don't know the percentage, but it's a lot.
78%.
Yeah.
What tools do you guys use to determine whether your strategies are significantly winning? you also mentioned you guys use neural networks. I created some neural networks of my own, and they are very likely to overfit in sample.
Yeah.
So I use different techniques. But what techniques do you use for these purposes?
So, to specifically for neural networks, just the standard practices. So we have a training set and a validation set. Often we either have a separate test set, or what I like even better is that while we're training and validating, we just take the data, of the next days
Out of sample.
to have that as a test data. So always temporal, always the training set is first in time, then the validation set, then the test set, because you're actually also fitting on your validation set, of course. So you have to have your test set in the future. To avoid overfitting, we use dropout, we use sort of the right size of the network. But in the end, I don't really care about the cost function, how much it goes down, and I care about in simulation how well it performs, and I care even more about how well it performs in real life.
Yeah.
So there's sort of different layers of the, as the English say, the proof is in the pudding. In the end, if we put it live and it makes profit for us, that's when I can say it works. Because on your training data, it's always, it looks so good. You can perfectly separate the winners from the losers. It's never that easy in real life. So some of those, I'm sure you've encountered a lot of the same things. And any smart insights you have that we are missing? Or,
So do you have like a certain amount of time you use as a benchmark? So let's say an hour. So if strategy is winning for an hour, we'll assume it's significantly winning.
So when we put something live in trading, I am becoming a little bit OCD. I've got my thing on my phone and check every minute whether it goes up and down. For trading, what I really like about high frequency trading, on most exchanges there is a sample coming about every second. And on large exchanges like Binance or Bittrex, you have 200 pairs. So that means you've got per day 100,000 seconds times 200 pairs is 20 million points per exchange. And we have 10 exchanges. So you have so many data points to evaluate, to train on, to test on, and even a day that you can pretty quickly see whether something works or not. And, in the end, it's just putting it live. At one point, you just have to put it live and see how it performs. And if it doesn't, we shut it down. And you have to be harsh about that as well, because if you spend a month working on something and it doesn't work, it's difficult to kill it. Oh, maybe tomorrow it will make a profit, but at some point you just have to
So you guys don't use correlations to check whether things are significant. You just put it live and see if it's winning for quite a amount of time.
So we always check against the benchmark, of course. So if you're a market maker, you often have to hold various coins to be able to buy and sell them. So we look at the average balance of those, and we look at what would have happened if we just hold those. If we don't trade, but let's say on average we have 1 Bitcoin, 5 Ether, and $1,000. And if we hadn't traded, but we just hold those for the same period of time, what would be your return? And sometimes your algorithm goes up, but if you hadn't done anything, it might have gone up even more. So then your algorithm sucks.
Really basic.
Yeah.
This is the buy and hold strategy.
Yeah, exactly. And if we
there must be better strategies to function as a benchmark.
Perhaps, if you know any, I'd love to chat about it afterwards.
I know some of them in the stock world, but not in the cryptocurrency world. And I think it's still too early to expect a neural network to be really functional in cryptocurrencies.
Okay.
Because the liquidity is so low, the number of exchanges is extremely high. Not all pairs are traded on many exchanges. So what you're doing is take just a small picture of the big world and try to win there. And all kind of things are happening, which will influence the success of your trading strategy.
Yeah, it's a very interesting remark. I have to disagree a little bit for two reasons. One, we are paying the rent by what we're doing, so there must be something we're
Okay, that
doing
means that
right.
you already have a benchmark better than buy and hold.
Oh, no, sure. From a benchmark point of view, yeah, that's right. And I think, to your point of neural networks, it being difficult in the crypto world because it's so illiquid and so new. Yes, it makes it more difficult to train them, but it also means there are more imperfections in the market that maybe you can recognize. It's more my hope than my thinking, maybe. But
I think there are a lot of imperfections right now.
Yeah.
And you might optimize on taking care of those imperfections.
Exactly, and
they
where it makes
might
money.
disappear in the near future.
Well, yeah, that's basically our job, right? To make them disappear and to help.
So you probably have to reconsider your portfolio all the time.
Yeah, of course, yes. So and that's really what I think. What keeps our job interesting is that like every month, maybe once a month, we have a new algorithm that's really great. All right, yes, we done it. We can go on holiday now. And a month later, you won't make any money with it anymore because the market has improved, the market has changed, and you have to come up with something new. So totally agree.
You mentioned I saw on the slide that we are using TensorFlow.
Yeah.
You are using the main functions like DNN, or you're also making your own functions?
We're using Keras as well, which is a wrapper for TensorFlow. Are you familiar with Keras at all?
No.
Okay, so if you look at the stack, which I think is somewhere here. So Keras is a library that is actually made also by people at Google that makes it really easy to work with TensorFlow. So Keras is just, you say, okay, I have a network, my first layer is this, my second layer is this, my third layer is this, enter. That's basically what it does. So we are, let's say, where we are innovative is really, for instance, feature engineering. It's really thinking about what do you present to the network, not just prices, but maybe returns or maybe order books at a certain depth or aggregations of trades, those type of things. We are not very far at thinking of new types of neural networks. So we use just standard densely connected nets. We use convolutional neural networks. We've looked into LTSMs, LSTMs, but haven't been able to get any good results with those yet. So it's So we're working with it, but we haven't invented any new types of neural nets or new functions. Yeah, we're not as advanced in that point of view. But you should check out Keras. It's really good.
One last question.
I have two questions who are kind of similar. How did you put your technology stack together? And the second question is, are you guys developing or software engineering anything, or is it just?
That would be a great question for you, I guess.
Yeah, so for the performance parts, so the parts, let's say, getting the data from the exchanges, we develop it all ourselves, based on Linux and Go, and we use InfluxDB as a database. We've looked at Redis as well, but yeah, there's so much data that it became a bit prohibitive and expensive to do it. And Influx was performant enough to store it all the time. So. The trading part is a little bit less heavily on the CPU, so it's mainly based on Python.
Yeah, so we are programming 90% of the day. Any minute we spend on administration let me put it differently. Any minute we spend on business stuff, administration, stuff that isn't related to thinking about algorithms and working with algorithms, in my view, is overhead, is wasted time. Right now we spend almost all of our time programming, and because there's so much to do, we actually want to reduce that. So we want to be maybe 50-50, where we have so many tools and so many stuff to work with that a lot of things are automated. So we have a software stack that does most of the we don't have to program as much anymore, and we can spend half of our time on the whiteboard thinking about smart structures, better neural networks, and really thinking and doing smart stuff. It's sort of the way we divide things. So thanks, guys. I think Bobby is finishing
round of
up
applause,
here.
please.